taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
All right, welcome to Total Money Management. We're going through the week that was, July 8 to 12. How we doing, gentlemen?
We're good.
We're back.
Bit cool, isn't it?
It is brisk. Very brisk.
Is Rome burning?
Well, that's what we're going to find out. So
there we go.
The key points today, thank you for leading us off, Jacob. We're going to figure out if Rome's burning. The US market disconnect, Uber anger. It was the best of times. It was the worst of times.
Like that one?
That's pretty.
Look, I'll tell you shortly.
Poetic.
You know that's art, don't you?
That is art, yeah.
That is.
Right, okay.
We're going to be talking about metals and money. And then, as usual, we've got a short story in there as well. So, do you want to kick us off with the big issue, Mr. Senior?
Yeah, well, look, it would seem, as per the article that we're going to run through, that there's an increasing number of people struggling to keep up with inflation and interest rates. It would seem that, and it definitely is happening. And it can't last unless we believe that the future is going to be largely miserable, at least the next 5 or 10 years for many Australians. And look, history is showing that these circumstances never really persist because voters toss out governments and they don't do anything to assist their standard living or quality of life. So there's a lot to run through. There's a fair bit of doom and gloom that we keep talking about. I'll keep coming back to at least over the next few years, and hopefully we'll give people a bit of a map to navigate that. So.
You can still invest. You can still invest and make money. It's just like we've said, you've got to be a little bit more careful. And as you mentioned, Tom, last week, you've got to rebalance a little bit more often to capture the profits while it's there in stocks.
Yeah.
Best of luck doing that in property. But my point being, you know, instead of saying I'm going to be a buy and holder because I'm in a secular bull market, you can't do that. So you've got to rebalance and more often. And then you've got to work out whether, you know, after 6 months, do you take 20% because you're going to take a hit on the capital gains? And, you know, so it's not more complex. It just means you've got to think through that your old strategy of, you just buy stocks and they go up because we're in a bull market is not applicable. It's a little bit more difficult in terms of global investing, right?
Yeah.
You know, can I buy Argentina? Are they going to be all right? You know, that sort of stuff. Whereas in a bull market, you can just buy anything, and then generally you'll do all right.
Yeah. Or there's an early acceptance that you're just going to keep feeding money into the market if you are a buy and holder, and you know that over the next 10 years it's probably not going to do much other than the money that you're putting into the market.
Yeah. Inflation will eat it away, or fees will eat it away. And I think that the sort of the idea of, you know, is Rome burning is basically, my perspective is we've got a really serious problem with inflation because it's not demand driven. So it's not everybody running out going, oh, give me stuff. It's actually the companies who are in oligopoly positions like Woolies and Coles to just bung up the prices of chocolate, right? Why? Because there's nowhere else you can get your chocolate. So that's
the whole point for you, isn't it?
Well, it's a good point and a bad point. It's a good point because you can actually, governments can have a little bit more authority over those companies by saying, well, you know, like I think Peter Dutton came out a couple of weeks ago and said, you know, we'll look at breaking them up, right? Well, companies don't want that going on. So if there's only two of them, they understand they're in an oligopoly and they can charge higher prices. But government can also come in and say, listen, you blokes, you need to wind this back a little bit or we'll get serious. So companies might dampen it down a bit. If there's 10 companies, well, there's enough competition to keep the prices fairly modest, right? And Australia's always been a country that has had oligopolies because there's just not enough of us to have 3 airlines. Right, there's just not enough of us to have, you know, 4 supermarkets. And so we end up with these companies that make consistent profits, which is really good for the stock market, right, if you're an investor. But it's a car crash if you're out there trying to make ends meet by buying stuff from Woolies and Coles, right? And what I'm saying here is the property market is a really serious problem. Inflation is a really serious problem. And it seems like Albo is just sitting there going, oh, well, you know, we're going to build a lot of houses. It's like, mate, could you just have a little bit more of a sense of urgency about what's going on? And that's why I'm saying, is Rome burning? You know, they're fiddling while Rome burns. It's like, guys, can we pay attention to this? This is really serious stuff. And they're, I think, relying on, you know, tax cuts to save the day. And I don't know whether that's actually going to work.
Yeah. Well, it's to your point, it's the little things. There'll be a bit of a tax cut and there'll be a 1% wage rise in a certain demographic area.
Well, you know, you get a 4% wage rise. Oh, that's good. Inflation's at 6%. And it's like, oh, okay. Yeah. Well, you know, you're not any better off.
Yeah, my grocery bill's conveniently gone up from 300 to 360. My insurance is up.
Exactly.
It's like, where's it going?
What's the plan?
Yeah, it's look, safe to say most people are feeling it, right?
Absolutely.
Monday, we just talking about the US economy is strong, but the market is extremely lopsided in favour of the Magnificent Seven.
Yeah.
And we've obviously harped on about NVIDIA, and, you know, Tesla did the same sort of thing, like absolutely ridiculous. But the problem is it's obviously super lopsided, Cape at 36.5. And the problem is, look, they're just overvalued. It's that simple, right? And it's disconnected with what's actually happening in the economy.
Well, you got people saying, oh, the S&P is going to rocket 100% in 5 years, and you got the other side of it going, well, hang on a minute.
It's all going to hell in a handbasket.
Yeah, who's got any money?
I mean, imagine like the S&P rocketing 100% in 5 years. Like, surely you look at that and go, well, no. But I suppose if you don't really understand and you've been making so much money over the last 20 years.
Yeah, but you know, 96, the Cape ratio was really expensive, right? And in 2000, you know, to this guy's point, from 1996, the US stock market doubled in 4 years. Yeah. And I went and had a look. I mean, I think you can, Jacob, if you toggle forward to the chart of the week, right down the bottom, you see their real GDP and S&P total returns, right? Mm-hmm. Well, look at it in, what did I just say? 96, right? So 96 to the S&P went up 23, 97 it went up 33, 1998 it went up 29, and 1999 it went up 21. I mean, man, as I said, it doubled in 4 years.
And the Cape was already pretty expensive in 96.
Exactly. And at 2000 it was 44. Here we are at 36 going, man, this thing's crazy. Well, imagine if it gets... So do you know what I mean? Like, this is the hard part of timing.
Just irrational exuberance.
You just have to say either, and to Tom's point earlier, you have to say, okay, I'm going to seriously rebalance every 12 months, or you say, well, I'm just going to try and ride it as hard as I can, but you've got to be really, really careful.
Yeah.
Right?
You've got to be able to keep tipping money in. Right,
exactly.
It's a dollar cost average, which is what everyone likes to talk about.
But then, Tom, you miss all the, you know,
I get it.
The dollar cost averaging on the downside. Yeah. Whereas with Cape, you wait at 44, January 2001, it's still at 36 or something. You're going, hey, the market's fallen 20%. It's like, yeah, but it's still at 36.
Yeah.
Right.
Yeah.
So,
in 2000, 2001, 2002, over those years, you know, we dropped 10%. The next year dropped 12%. Next year dropped 22%.
Yeah.
So you've knocked half your returns out.
Exactly. So you went from 100 in 96 to 200 in 2000, and then from 2000 to 2003, you went from 100 back to 50. Yeah. So in other words, you went nowhere. Mm-hmm. But if you rebalanced every year and said, listen, I'm going to take all the profit or I'm going to take 50%, you've at least banked some profit. And when it falls from 2000, from 100 to 200, if you've sold down, you might have, say, 150, right? Well, it loses 50% of that, which is 75, but you banked, you know, 40, so you're not as badly off.
Yeah, and then you pour your money in and you end up with way more shares than you had the first time around, and then as it goes up again, you're absolutely laughing.
Yep.
That's what we're trying to kind of, that's what we keep harping on about,
so
right?
we're trying to tell people.
It's like a broken record,
I tell you. All right, Tuesday, rates will be lower, Uber plan to cut prices, and this angers drivers for some reason.
There you go. Isn't that strange?
Can't imagine why.
Who would have thought 10 years ago we were talking about Uber in a weekly newsletter?
Yeah.
Have they made any money yet, Uber?
Good question. I think they're just breaking even, as far as I know. I tell you, he's not breaking even. The drivers.
Yeah.
But it's just that.
And they work hard for what they do. Like they do
and look
crazy hours.
And look at petrol prices.
Yeah.
Well, a lot of them run on hybrids.
They got EVs and stuff.
and
now.
EVs.
But they're still not cheap to run, in that sense. I assume they're cheaper.
Yeah, I
when
think they
energy
get
prices
1,200
go
Ks out of a tank or something with a hybrid, thereabouts.
Yeah, but you still got to buy. My understanding is that, the batteries last a certain amount of time and a new battery's hideously expensive. So it's you know what I mean? Like you say, hey, I'm paying 3 cents a kilometre when it's actually like, no, it's 7.
Yeah.
By the time you put it in over the life cycle.
For me, it's like the general lifestyle as well. Like they're working from 9 o'clock at night to 4 a.m. on a Saturday, every Saturday. Like what?
With drunk people.
With drunk people
And they're
vomiting all
dealing
over
with,
the cars.
belligerent.
Yeah, I mean, good
Rude.
on them. Like they're absolutely
I've got
hustling.
all the time in the world, and they're so helpful. It's so handy having someone,
What, Uber?
Yeah,
Oh, yeah.
absolutely.
Yeah.
Amazing. But, man, like, that is absolute grind.
And to the point here, it's showing that they're employed. So employment rate is not really
unemployment
going,
rate.
Unemployment rate's
Yeah,
not
yeah.
going up. And you're like, are they really employed? Like it's so they're making it.
Well,
money?
Contractors.
It's
right?
my argument there is, look, if you're my age, it was always about unemployment. Oh, unemployment's at 4%. Oh, the economy must be going gangbusters. Unemployment's at 10. Oh, the economy must be terrible, right? But those days were full-time jobs, whereas now the labour market is so dispersed. And what happens is, like you were saying, Jacob, you've got an Uber driver and you're going, hey, the dude's got a job. Yeah, but he's earning $300 a week. He's not actually rolling or committing to the economy because he's basically on subsistence levels, right? But he's employed. So what I'm saying is that you look at it and go, I do this all the time. I still can't get used to it, where I look at the unemployment rate at 4% and people going, oh, things are great. It's like, bullshit, get out there in the economy. It's terrible, right? Because the unemployment rate now no longer reflects this state of the economy. Because we've deregulated the labour market, you think there's hardly any unemployed these days because everyone's like, oh, well, just go and be an Uber driver. Go and be a delivery driver. Every time I took the kids to Burger Urge, right, last night, and it's always like just a bit quiet. And I'm like, how do these places
Uber
make
drivers
money?
going in
There's
and out.
Uber drivers walking in every 30 seconds, like everybody's ordering meals and sitting at home. And to someone like me who's old, it's a bit like, well, why are all these seats vacant? And it's because, like you say, my kids do it. My daughter had a friend over. They Uber Eats 3 times in one night. I said to him, darling, this is ridiculous.
on Dad's car.
Yeah, Daddy, can I have your phone?
But you know what I'm saying is that, in my day, we never did that because it was never, first of all, it was too expensive. Secondly, it's not like I had Dad's credit card on my phone where I just went, Jim, go, hey, Dad, there's an Uber guy at the door.
You had to make a
That sounds
conscious
like
decision to go out.
Sounds like your problem.
Yeah, well, yeah. Well, your kids are younger than mine, so just...
They ain't got my credit card on their phone.
Oh, really? Yeah, just 100%. Wait. Yeah, just wait 10 years, Buster. Yeah, we'll be back here and I'll be going, how's those kids, Tom? Ching.
No, we'll be at the retirement village and you'll be...
Yeah.
We're going.
You'll be in the Bahamas. Bitcoin's 156 million, Steve. Get in. It's not too late.
It's still cheap.
What's on Wednesday?
Yeah, there I'll be with my ETX
Well,
index.
Tesla went up 50% in a month.
Beautiful.
This is crazy, but there's going to be a lot of people who believe that a 50% move in 1 month is not irrational.
Absolutely.
It's outrageous, isn't it? Saying that from the Bitcoiners.
Yeah.
50%.
That's tame.
Hello, pot kettle.
Yeah.
But
Take
it
some
is,
money,
yeah.
guys.
It's gone up. There was something else I checked. Nvidia, I think, has gone up. Oh, God. I was going to ask you, Tom, can you just jump on Nvidia year to date? I think it's something like 230% or something. Like, it's just crazy. That's why I'm saying, it just concerns me that we're getting a bit carried away.
It'll be about that, yeah.
Radio silence, folks, while the boys check the stock
We're
price.
finding the video.
Let me hum a tune to you.
It's at 1% on Friday. What are we? Year to date, you want?
Yeah. What's Nvidia year to date? I think it's a double or something.
January, bang, to now, 151%.
Oh, is that all?
Just a little bit. Oh, the top was 173.
Right.
Yeah.
So there's, quote, been a pullback.
Well, if you look at the technical analysis side of things, it looks like it can't quite create a new high.
Oh, do tell.
And the bearish engulfing candle from Thursday suggests
what,
we
mate?
might have a pullback.
What was it, mate? A bearish engulfing candle.
Where this candle here is
Holy
engulfing
dooly,
the other
wow.
week.
That sounds
Yes.
serious.
But it's just bounced off the 20-day moving average, so we might see another push.
So you just draw straight lines from the top to the bottom and that,
Mate,
that
I just
little
draw
channel-y stuff?
I just draw triangles and circles on it and say it's going to go up.
That'll be $50, please.
A week.
Oh, God.
Yeah.
Things we do. Anyway, look, folks, the Magnificent Seven. Get in or get out, I have no idea, but by golly, they look expensive.
Just have a strategy around if you're going to have a week that does 20%, take a bit of money off the top.
Yeah, that's
Do yourself
probably
a
a
favour.
sensible thing to do, young man.
Took us way too long to figure that out,
Yeah.
even with you in area. Thursday, things gone a little pear-shaped in New Zealand. Given the similarities with Australia, it's hard to see how it could be any different here, right? Little Warren Buffett quote in there, when the tide goes out, we see who's swimming naked.
Yes. New Zealand is now, and I think we talked about it in the last episode, about the similarities between the US, UK, Canada, Spain, Ireland, where all the property bubbles are, right?
Yep.
They're always the same thing, right? Cheap money, low rates, speculation, talk about capital gain, all that sort of stuff. And that's what went on in New Zealand and has been going on for quite a long time. Well, now it seems to be coming to an end. And this headline is, if you're forced to sell, you're screwed. Mortgagee sales expect to rise. And so they're saying things are really, starting to decline in New Zealand. And my argument is that people say, oh, well, that's all right. Albo will step in and fix it, or the Reserve Bank will do something. That's not the way it works. The way it works is people look at a house price and go, I'm not giving you $2 million for that. Whereas, last year they would have given you bloody 2.4.
Yeah. We're forced to sell out. People lose and people win. It's as simple as that.
Well, that's how markets work.
Yeah.
Not everybody can be a winner, unfortunately. But
So New Zealand, just entertain me for a sec. New Zealand have gone through a property bubble, or they're going through a property bubble?
they've gone through one.
Right, okay. I always forget about them across the ditch, don't you?
Wow, it's only a couple of million. Hello to all our New Zealand listeners.
There's a few, actually. Sorry about that.
But they're good at footy.
That's true. So basically, we want to stay clear of New Zealand for a bit and then buy in a few years.
Yeah, well, again, you just, you look at the yield,
Yeah.
right? But again, the general direction, if you look at it and go, oh, the yield's at 3, oh, that's not bad. But you're thinking, yeah, but it could be 4. If the price falls 100,000, well, that's substantial amount of money, and it makes a big difference when you look at the price. And I think I've done this before, where I've said, if the property was 600,000 and you borrow 500. If you look at it and said, oh, well, I'll wait for it to get to 500 and it gets to 5 and you have to only borrow 400, the difference over the long term is substantial, right? And what I'm trying to say to people there is, look, and it's the same in stocks, if you wait for cheap markets, you do really, really well in one bull market.
Well, it comes down to the price you pay.
Exactly,
Yeah.
and the value, Tom. So because that's why the yield is important, because it gives you an indication as an investor. I'm not talking about a property owner,
Yeah.
but as an investor, it gives you a really good indication about what you're going to yield, right? And what a lot of people are finding out now is that the yield might be all right, but if you lose $100,000 of capital in the property, well, you've got 40 years of 2.5% till you get that $100,000 back. So you see what I mean? Like, there's a big difference in what your starting price is. that determines what your yield is. And if you want to jump in and, buy high, sell higher, as they say, by all means. But boy, oh boy, it's really risky because you've got to be able to know where the top is, what's the liquidity, where the interest rate's heading, all that sort of stuff. So it's much easier, in my mind, just to go, everybody hates these stocks, it's really cheap. Okay, we'll buy some.
Yeah.
Right, it's asymmetrical, right? There's heaps of benefit on if it goes up, it'll take, it goes up 100%. If it fails, okay, I'll lose 2% of my assets. All right, well, take a bet.
So we're taking a risk because the music stops eventually on all things.
Yeah, but that's why we talk about market cycles, because you can at least say, listen, it's near the end of the album. Right? We're at the last song.
And the credits.
Yeah.
All right, so Friday, there's a reason we hold both the resources ETF and the financial ETF in the World 3 portfolio. And it all really folds into diversification and the benefits that has along with rebalancing, just leading to higher returns and the mathematic behind rebalancing every year, 18 months, 2 years across diversified assets.
Yep. The reason why I hold, not a recommendation, the resources and the financial ETF is because if you look at Australia's ASX 200, 300, whatever you want, banks and resources are the two big ones, right? They will make a difference to the market. So if you hold the ETFs, what you will do, and so if you held the ASX 300 and you held the bank ETF and you held the resources ETF, if you rebalance those, you will make more money over the long term because you're pruning the winners and putting the money into the losers. The losers then become the winners and the winners become the losers. So you're taking advantage of the volatility. Okay. Yeah. And so when you say, well, banks and resources are, I think they're like 60% of the market or something, right? Well, they're the big hitters where you can just rebalance between those two. And indeed, the big issue this week was the Commonwealth Bank is now larger than BHP.
Oh, wow.
Yeah, number one on the ASX.
And 60% of their books are residential mortgages.
Hey, bingo.
Australia's gone to its knees. No, not really. I might do.
Well, they always say that, Australia's houses and holes, and this week it's like, yep, it is actually. But on a serious note, the point is, if you rebalance between those assets, you'll do better than generally just leaving it in the market. Yeah. Right? So it's what we talk about in Well 2 with our sector strategy.
Yes.
Right?
Well, hopefully by now we've banged on enough about rebalancing and asset allocation that people have gone and started to look into what that is.
Yeah.
Once you understand that, you kind of realise that most of us are overcomplicating things.
Yeah.
Yeah.
I mean, you buy stocks and you sell stocks. There you go.
Yeah.
It's not really hard, is it?
The emotion.
But which one? And when do I sell?
Yeah,
and
well,
when do I buy?
yeah.
Steve.
Yeah. Well, there you go.
When can I be?
Which one's going to make me money?
That's exactly what you get trapped in.
Yeah.
Right?
So,
you get trapped in the emotional stuff.
Yeah.
I think I'm going to pass to you for the short story. We've resorted to collages. And
this is really to benefit the members, I think, because they get a read through of it.
What's that? The short story?
Yeah.
Why? What's wrong with it?
Well, it's a really nice collage.
Yeah.
Of not much that I can understand.
Why not? Can't you bloody read? You're English, aren't you?
We're blaming China for cyber attacks. Home loans in May still jump 18% year on year. So people still borrowing and buying houses.
Yeah.
Which is...
So you're picking a theme here, fellas? You got it? Geopolitics. Australia takes rare step in blaming China. What's the first article? A comprehensive audit will be conducted into all internet-facing technology used by Commonwealth over rising concerns about foreign influence. They might even go together. And then what's the next one? In America, our goal is to have a significant package of China-related legislation signed into law by the end of the year, right? Prohibiting China's biotech trade reform. You see, this is again tying back to the new normal by saying, if you look sort of behind the headlines or you look at it and go, oh, I wonder what's going on there. You're looking at it going, these people are not friends.
Yeah.
Right?
Well, they're just whacking on tariffs and it's just one thing after another.
Yeah, but what I'm also saying there, Jacob, is, again, what we talked about in the last episode, right? We don't want EVs if they can track them, right? See, in the old days, you could buy a Japanese car and it didn't matter, right? You'd bring it in from Tokyo and you go, great, I got my, Toyota Corolla. Now, if you buy an EV, they have control of the data, right, in the car. They can control your car. Right, but Tesla owners get locked out and all this sort of stuff. So what I'm saying is the Chinese government are sitting over there going, oh, look at all this data we're getting from all these cars we're selling in Australia. Oh, look at what all these people do. Right, that's the critical point, and that's why cyber stuff is now really, really serious, because they're hacking the data, and I think there was a few years ago where they hacked into the Department of Defence's new building. Right, like it's really serious stuff, and I don't think we're paying enough attention to it as investors, because it's this is really straining relationships, and I can tell you it's not gonna change. The world's becoming more hostile, and you've got to be a little bit more on the ball as an investor, rather than just saying, oh well, I'll just buy I'll just buy a global portfolio of ETFs and it'll all be sweet, and it's like no, it's not going to be sweet. So that's what that's the first one. And the second one I'm just talking about there is the emphasis is coming on property, like we've talked about, where governments are starting to put pressure on Airbnb owners. Yeah. They want rental standards lifted. Well, that means the landlord's going to pay more money. That means they're going to charge more rent. Yeah. So, and in this one, you've got the government are now starting to talk about bringing real estate agents in under the foreign money laundering stuff.
Right.
Well, no one's talked about that before.
Why?
Right? Well, because criminals can come and buy an Australian property for 20 million, sell it for 18, they've just rinsed their cash. Now they've got $18 million.
Yeah.
That's the way, that's what they call laundering.
And they'll find a real estate agent that'll do that.
Yeah.
Yeah.
Yeah, well, what, as if he's going to go, oh, no, I don't know whether you're on the level.
I don't want to make $1 million off this.
Yeah. Look, I don't think that's kosher. Let me report you to the authorities. No.
Well, when you got how many percent of houses are being bought cash?
25. 25 or something.
Almost 35 from the one we did a few weeks ago.
Yeah.
So, yeah, right. And a lot of that will be dodgy dodge.
Don't know.
Well,
not my call. It
I'm
sounds exciting if we say it is.
Well, you don't know how much of it is, but I'll bet you the authorities know how much it is.
Yeah.
It's just a question of political will to say, listen, we need to crack down on this.
Have you seen it like the casinos? It's been obviously.
Exactly, Tom. Exactly. That's what they do. They do it in Hong Kong. All the Chinese go over to Hong Kong, and I think we talked about it about a year ago. There was the routine of, I think it was with watches or something, or credit cards or something, where you send, $1 million over and then they give you 800 cash back. So they take a cut, but you get more money. You get to wash the cash.
Yeah.
Right? I did it years ago when I was a salesman, and I think I told this story a while ago with, I won't go into who it was, but they wanted to set up a shop. Right. And I said, look, I was like 22 at the time. Right. And I'm saying, oh, yeah, you're going to need this. And they're like, no. We just want a fridge and, like a chicken rotisserie. And I'm like, oh, right. OK. And you'll need a, cash register and blah, blah. No. I just want a fridge and I want a chicken rotisserie. It's like, oh, right. OK. Well, they were going to sell like 500 million chickens every week, right? Yeah. Because you see what I mean? It was like the police would walk in and go, man, you got, wow, you guys are like pumping through a lot of chickens from this chicken shop. It's like,
not a chicken inside.
We have a special recipe.
All cash.
Exactly. So, that's what I mean. Everyone knows it goes on. It's just a matter of whether the political will or the pressure becomes intense where they say, okay, we got to start. Yeah. We've got to pay attention. And Australia is, I think, one of the few places that haven't done this. So that's why we're probably getting more than our fair share of dirty money.
Yeah.
Right? Because we're one of the places that are accepting it.
Right, okay. Bit of pressure from the
care more about being seen to be doing the right thing than actually doing the right thing.
Well, yeah. The other thing is, Tom, I think that you know, no one wants to come out and say the problem the government has got, and I empathise with any government, because if you've got a bunch of people going, listen, the house prices are crazy, I'm being crushed. You've got another bunch of people going, who cares about the renters? You know, because they're the landlords. And so we're all just acting in our own self-interest. But the problem for the politicians is they can talk all they like about affordable housing, right? You know what that's code for? Lower house prices. And, you know, as a property investor, you'd be going, okay, well, that's fine, but I don't want it happening on my watch, right? Because you know, your mortgage for $2 million on properties, well, the last thing you want to hear is Albo going, mate, we're going to smash that property price down from 13 times income to 5, right? So they're really just sort of fiddling at the edges, hoping that something happens where they don't get blamed.
And they've probably got houses themselves.
Well, yeah.
So there's that.
Well, absolutely. Yeah. But that's you see what I mean? It's sort of like, well, there's not only their own interests where they'd be going, you know, you see it in the American stock market. This week, Congress passed, and I think it was just Thursday, they got a bill passed which said that congressmen and women can't trade stocks anymore.
Yeah, right. Yeah.
Right? Because you see, you'd go into a meeting, right, a political committee meeting, and they'd say, righto, we're going to agree to do, you know, AI chips or something, right? You slip out, you ring your broker and say, listen, mate, put 500,000 on NVIDIA.
Yeah.
Right? Yep, cheers, thanks, buddy. Click. 2 weeks later, you get an announcement, AI's the big thing, politicians go boom. Right? You look at, the big one is Nancy Pelosi. She's, you know, her salary is like 800,000. Her stock winnings is like 3 million. Like, she buys all NVIDIA calls and all this stuff, right? Because she gets a heads up on all of it. It's insider trading.
You only needed an hour to make a call.
Absolutely. It's insider trading. That's what it is. But they get the advantage of it because they're politicians.
Yeah.
And I wrote to a mate of mine during the week and said, you know, politicians in this country bang on about us, you know, mere plebs supporting Australian industry, right? And so, i.e., you should buy Australian shares, right, because that provides capital for Australian industry.
Yeah.
Look at politicians' portfolios. They're full of bloody residential properties. Well, hang on, you guys. You want us to invest in Australian companies, but all of them have got 2 to 3 investment properties, right? And they're unproductive assets. But they're part of the problem, pushing the house prices up. But we expect them to go, you know what, I'm going to sacrifice my house prices for the good of the nation. Don't think so.
Yeah, that's the trouble, right?
Absolutely. Righto, is that it?
That's it.
Worried about looking at your watch there, Tommy boy?
We're done for another week. You got somewhere to be, Tom.
Yeah, somewhere more important than us.
Joking. Well, look, we'll wrap it up. Before we press the big red button, if you want to check out any of these things that we're talking about the week that was, head to the website totalmoneymanagement.com.au. By now, there'll be a free ETF for beginners course as well, which you can sign up to and give us some feedback.
And look at the chart of the week.
Look at the chart of the week.
Before we escape, I just want to talk about that because it's really important.
Okay.
It really shows you the benefit of valuation, okay? When the economy's booming, like it is now, right, you think, oh, well, that'll be good for the stock market, like it is now. But if you look at the CAPE ratio, when it's above 25, the returns are terrible.
Yep.
And just a little reminder, folks, it's at 37, right? When it's below 25, the returns are fantastic.
The stock market is not the economy.
Thank you.
Awesome.
We'll see you next week.
Thank you.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.